All right, so we are still looking at the cash flow statement. And what I want us to look at right now is the operating activities section of the cash flow statement. Recall that operating activities is the explanation of the difference between what's on the income statement and what's under accrual basis accounting and what's actually received or paid in cash. So this is going to include things like cash collected from customers, cash paid to employees, cash paid for income taxes, and so forth. And we classify them as inflows, cash received, and outflows, cash paid. Now, there are two methods of accounting for the operating or reporting the operating activities section of the cash flow statement. And these two options only apply to the operating activities section. That is the direct method, where we take each line of the income statement, starting with sales revenue, and translate that into cash flow. So sales is translated into cash received from customers. Cost of goods sold is translated into cash paid for inventory. Wages expense is translated into cash paid to employees, and so forth. The other possibility or other method is the indirect method, and we'll talk about that in a different set of videos. So what I want us to do now is switch to my spreadsheet. If I can get, there we go. And we're going to take a look once again at the problem 1318. And before we get started with the operating activities section, I want to remind you that every financial statement has to have an appropriate heading: who, what, and when. So the who, Miracle Tools in this problem; the what, statement of cash flows, direct method; and the when, like the income statement, the cash flow statement is for a period of time. So this will be for the year ended December 31st, 2018. Now, the operating activities section, as I said, we start with the income statement items. So I'm going back to our data section. And on the income statement, we're only interested in the current year. And sales is our starting point. Sales is $350,000. Now, sales is related to two balance sheet accounts. We can have cash sales, where customers pay us immediately, or we can have sales on account, which flows through the accounts receivable account. So we're going to be adjusting the sales figure to cash collected from customers by looking at the change in accounts receivable. So back on our cash flow statement, we're going to call this cash received from customers. And as I said, we're going to start with the sales figure, which was $350,000. And then we're going to adjust that, either increase it or decrease it for the change in accounts receivable. So let's go back to our data template and scroll down till we find accounts receivable on the balance sheet. And we see that accounts receivable decreased by $17,000. Now let's think about that. What causes accounts receivable to decrease? Customers paying us what they owe us causes accounts receivable to decrease. So if accounts receivable decreased during the period, that means we collected more cash from customers than they charged for sales on account. So that decrease in accounts receivable under the direct method will be added to the sales figure, and that decrease in accounts receivable again was $17,000. The opposite would be true if it were an increase. We would subtract an increase in AR from sales. If accounts receivable increases, that means that we sold more on account than we collected from customers on account. But in this case, it was a decrease, so we add it. So we've got $350,000 in sales plus the $17,000 decrease in accounts receivable. So our cash collected from customers is $367,000. Now, I just want to make sure that this all makes sense to me. So I'm going to take a look at our old friend, the T account, for accounts receivable. Again, I'm a very visual person, and I'm also an accountant, so I think in terms of T accounts and how transactions affect those. So we'll start with the beginning balance from our data section. Our beginning accounts receivable was $40,000. Last year's ending is this year's beginning. So the beginning was $40,000. We know what sales was, and assuming all sales were on account, those sales would be debited to accounts receivable and credited to sales. So we debit accounts receivable for $350,000, and then we just figured out we must have paid or collected from customers, collected $367,000 from customers. So we'll put that on the credit side because the entry to record collections from customers on account is debit cash and credit accounts receivable. And let's see if that explains our ending balance. We got $40,000 beginning plus $350, that's $390,000, minus $367,000, that yields an ending balance of $23,000. Let's look back at our data. Sure enough, ending accounts receivable was $23,000. So our logic was correct in adding the decrease in accounts receivable. And again, why? Because sales on account increases accounts receivable, but cash collections on account, which is what we want, we're trying to figure out how much cash did we collect from customers. Cash collections decrease accounts receivable. So if accounts receivable decrease from the beginning to the end of the period, it's because cash collected from customers was greater than sales on account. So we add that decrease to sales to calculate the amount of cash we receive from customers. And again, the opposite would be true. If we flip these numbers, if sales had been $367,000 and the ending balance and collections had been $350,000, then the ending balance of accounts receivable, so 407 minus 350, would have been $57,000. So if accounts receivable had increased by $17,000, that would mean that we collected $17,000 less in cash from customers than we had sold on account to customers. So we do the opposite adjustment on that one. So again, let me put our actual numbers back in here. And I'm going to stop this video because it's getting close to 10 minutes, and then we'll pick up with the other two types of adjustments in a separate video.